Ever pondered on how companies account for their long-term assets? Today, we're diving into the intricate world of capitalization, illuminating its process and importance in business. Imagine you're a business owner. You've just purchased a piece of machinery that's going to benefit your operations for years to come. This isn't just a one-off expense. It's an investment into the future of your business, a tangible asset. But how do you account for it? Here's where capitalization steps in. The first stage of capitalization is identifying the assets that qualify for this process. These are typically long-term assets, ones that provide future economic benefits and have a useful life extending beyond one accounting period. Think property, plant, and equipment, intangible assets like patents or copyrights, and certain types of software development costs. Next up is determining which costs associated with the asset can be capitalized. These are expenditures directly attributable to the acquisition, construction, or development of the asset. This could include the purchase price, direct labor costs, materials, overhead costs directly related to construction, and certain borrowing costs incurred during the construction period. Now that you've identified which costs can be capitalized, you need to measure these costs accurately. For purchased assets, this typically involves recording the purchase price plus any directly attributable costs, such as shipping and installation. For self-constructed assets, costs need to be tracked throughout the construction process. Most companies set minimum thresholds for capitalization to reduce the administrative burden of tracking and reporting minor expenditures. Expenditures below the capitalization threshold are generally expensed immediately rather than capitalized. Once the qualifying costs are identified and measured, they are recorded as assets on the balance sheet rather than expensed on the income statement. These capitalized costs are then amortized or depreciated over the useful life of the asset through periodic charges to the income statement, reflecting the allocation of the asset's cost over its economic life. Capitalized assets are subject to periodic impairment testing. If an asset is impaired, its carrying amount is reduced to its recoverable amount, and the impairment loss is recognized in the income statement. Remember, asset capitalization is not a one-time process, but requires ongoing monitoring and review. Changes in circumstances, such as technological obsolescence or changes in market conditions, may require reevaluation of the asset's carrying value and useful life. Finally, it's crucial that companies ensure that their capitalization practices comply with applicable accounting standards. Failure to comply can result in financial statement misrepresentation and potential legal or regulatory consequences. To recap, capitalization revolves around identifying qualifying assets, determining and measuring capitalizable costs, assessing capitalization thresholds, recording capitalized costs, evaluating impairment, monitoring and reviewing, and complying with accounting standards. It's a fascinating, vital part of accounting that helps businesses accurately represent their long-term investments.